the money that we put inside the banks do the same thing to us. They just don't ask for our permission.
If you just buy a policy with the top insurance company and don't do anything with it,
you just have a life insurance policy.
You're not doing infinite banking. You have to be able to understand how, this millionaire mindset that you have is going to either affect or effect. What's up, YouTube? Did you know that you finance every single thing that you buy, right? Because you're either paying interest or you're giving up your ability to earn interest. My name is Carmen.
And I'm Darius. And the unfortunate thing is we use the bank for both transactions. Mm-hmm. Everything that we need money for, we use the bank for every single thing. Mm-hmm. So the banks control all the money. They leverage the money that we put in there to then finance the stuff that we need.
Exactly. Now, that quote that I just shared with you comes from page 21 in the Becoming Your Own Banker book by Mr. Nelson Nash. It is important that I give him his credit because this is a very, very important point that he makes in this book, which is in the second paragraph. So I'm going to read it one more time. He says, the very first principle that must be understood is that you finance everything you buy. You either pay interest to someone else or you give up interest that you could have earned otherwise. Mm-hmm. Now, what does that mean? I think we need to break down each of these sentences. So the first thing is you finance everything you buy. You either pay interest to someone else. So let's talk about that point for a second.
So paying interest to someone else is just the thing that we do all the time, which is we use stuff on credit cards. We finance things through the bank, mm-hmm. getting loans. Mm-hmm. We finance things through third-party lenders when we want loans for cars.
Yep.
We finance
everything.
Mm-hmm. Everything is financeable or financeable. Is financeable a word?
We're going to make it a word today.
We're going to make it a word today.
Yeah, but the point that I wanted to say is you can hear a daughter in the background. The thing that I want to say with the financing piece is that the banks make it so convenient, so engaging, so exciting to finance. Why not use your credit card so that you can get points and perks and all sorts of things? Mm-hmm. But sometimes we just don't recognize how much interest we are paying out and how that directly affects our finances and the money that we're bringing home to our families.
Yeah, and I did an exercise a few days ago looking at our old debts. Mm-hmm. And what I did is instead of, doing an average of the amount of debts that we had, I did a sum of it. And it was over 120 something percent in interest that the interest equated to. Mm-hmm. And
when you add it all
when you add it all up, mm-hmm. and that felt different. And when I took a look at the numbers, most of the payments that we made went to interest. Mm-hmm. Now, that is a problem. That's a problem that a lot of us don't recognize.
True.
But what we should be also thinking is that, it might be a debt to us or a liability to us, but somebody else is making money from that transaction. Mm-hmm. And that's exactly what we should be thinking about when we look at interest. Somebody else is making money from it. So mm-hmm. We live in a society where there has to be winners and there has to be losers. But how can we position it to where there can be winners,
yeah,
and no losers?
Yeah. Mm-hmm.
And I think by changing the way we understand money and changing how we handle money, mm-hmm. then we can all put ourselves in a better position, because it's not like there's a limited amount of money out there mm-hmm. for all of us to be successful. Mm-hmm. It is. The only difference between someone that's successful and someone that's not is what we know. So if we can continue to educate ourselves and understand, maybe follow the money, follow our own money and see where it goes, we can put ourselves, we can do better with our money.
Mm-hmm. Yeah. I agree. I think you made some brilliant points, and I keep looking back to this book to make sure that we're covering everything. So going back to you pay interest to someone else, mm-hmm. and when we talked about the banks and how they make it easy for us to pay back, we just taught a class yesterday where we were talking about one of our minimum payments was $105. And that didn't kill us. It was no big deal. It was $105, and we were okay paying that minimum amount every single month, hence financing, because it didn't eat away a large chunk of our income. Mm-hmm. However, to your point, when we added all of the interest, all of the debts that we were paying, it ended up being over $2,000 that we were paying in debt payments back in the day. And again, we didn't recognize it, right? Because we're like, oh, we'll pay Amazon 100, we'll pay Wells Fargo another 100 over here. And we're thinking of these as like bite-sized little pieces, but not putting them all together to bring home your point. And when we added all that together, not only was it over 100% interest, when you just added all the rates together, we were literally spending $2,000 in debt payments a month. So just to bring that home so that you all understand what we're talking about, you are paying interest to someone else. So in your household, how much interest are you paying to somebody else right now? You may or may not know this answer. Is it 10%? Is it 26%? Is it a bunch more like how we were? So just think about that for a moment.
And when you find out that number, you get clarity. And clarity is key.
Yeah.
And when you
power.
Yeah. And when we started doing these exercises, what I personally realized also is the power of a contract. Throughout our journey, through our real estate experiences where we were lending money on real estate, it was our ability to create money was in the contract. Our ability to create interest, or create money was in the contract. And every time that money is lent to us and we are financing something, the power is in the contract. So we can create a contract, and I talked to our attorney about this. You can create a contract that's binding in court on a napkin. Yeah. So you can literally create money by putting a agreement together on a napkin.
It is true. Now, moving to the next point with the contract, let's talk about how we lose money, lose the purchasing power of our funds by just keeping it in a savings account. So the point that Nelson Nash says is, or you give up interest you could have earned otherwise, or you give up interest that you could have earned otherwise. And what he's basically saying by that is, how many of us have a savings account? How many of us are not moving money in our savings account? It happens time and time again. We're not keeping up with inflation that is eating away at our dollars every single day. And our money becomes less and less valuable. So if your money is not out earning interest and just sitting, then you're losing your ability to earn interest.
Out earning inflation.
Yeah, you're not out earning inflation. And then get this, not only are you not out earning inflation, but if you spend money in your savings account,
that money's gone.
Poof, it's gone. Now you did keep up with inflation. Now you don't have any more money to help you combat that. So we keep ending up behind the 8 ball. And that's why we always end up in this struggle, this push and pull of financial freedom or whatever this is for you. So these are the points that we wanted to share today is, we always talk about the banks. Again, we're not hating on the banks. We're just using them as a blueprint because maybe we can put our money somewhere else and it can work for us in many different ways.
Yeah, and the banks have a monopoly basically on our money. Yeah. All of our money flows through a bank just out of convenience. Totally. But what we can do is we can change where we store the money that we have. And when we talk about storing money, we're talking about storing money inside of a dividend paying whole life insurance policy so that we can at least keep up with interest. Yeah. Now, if we take it a step further, we want to leverage the cash value so that we can, instead of borrowing from the bank, we borrow from the life insurance company and pay ourselves the interest that the banks would have charged us. Yeah. What this allows us to do is to keep our money, our cash in a place that keeps up with inflation. And on the other hand, instead of paying interest to the bank, we can pay interest back to ourselves. Absolutely. And the reason why it's so important that we do continue to pay interest, because debt is the new gold. You cannot, our society would not work without debt. Our country would come to a halt without debt. Debt is super important, especially since in the 70s going from the gold standard where there's nothing backing our dollars. The only thing we have backing our dollars now is, well, we don't have anything backing our dollars, but what we do have is debt. So instead of us being indebted to the banks, to the financial institutions giving up our money, we can control it ourselves and pay ourselves the interest that we'd have otherwise paid away. Because when we look at over 100% interest that we were paying and now able to direct back to ourselves, not only are we able to put away more money, but we also have more money to leverage on bigger things. We financed our car. We're financing our own investments. What we're able to do is now control the contracts that we're writing.
Now, one thing that I think we need to address is the super ninja trick that comes with owning a whole life insurance policy. So let's compare and contrast where we talk about a savings account at the bank. This is why we're saying maybe you could put your money somewhere else. Maybe this is a better option.
Change the storage facility.
Yeah,
that's all the bank is.
It's just changing the storage facility. In your savings account right now, you are earning a certain amount of interest. It's very small. And the thing is every time you chip away at that savings account, you have to build it back up, right? It goes down, build it back up, goes down, build it back up. Every time you chip away, now you've affected the compounding that's happening inside that account. And now you're not earning uninterrupted compound interest, because every time you touch it, you've interrupted the compound interest, right? That's a visual for you. So now all we're saying is if we change the storage facility, all we're doing is moving our savings account. We always start with a savings account and we put it inside a whole life insurance policy. The super ninja trick is our money earns a guaranteed compounded rate uninterrupted. How is it uninterrupted? Because like Darius said, anytime we need to leverage our funds to finance something inside of our lifestyle, we are using our money as collateral. And we're just saying, hey, insurance company, you see I have 10 grand here in my insurance policy. Why don't I use your money instead? So that way my money doesn't get touched and I can continue to earn the uninterrupted compound interest. And
now I want to interrupt you there because what you said is something that we've seen before. It's something that we've all experienced before. The money that we put inside the banks do the same thing to us. They just don't ask for our permission.
True.
So it's the same motion, the same movement, but we can't do that same thing inside of a bank. We can do it within a life insurance policy, and we can borrow the money from the insurance company using our money as collateral, the same way the banks use our money sitting inside of our savings account as leverage to then lend that money out to somebody else so they can pay a higher interest rate and they keep profits. We're doing the exact same thing, but not even the secret sauce, but the key is changing the storage facility. That's nothing more than what a bank is, and we're just using a life insurance policy, a dividend-paying whole life insurance policy for the same purpose. Exactly.
And the question that we get all the time, I see it here in the comments, which I wanted to address, is Carmen and Darius, what insurance company do we use? At the end of the day, the insurance companies are the one with all the money. So work with a mutual dividend-paying life insurance company and make sure that you are partnered with an agent who understands how this whole infinite banking realm works so that they can coach you through it.
Yeah, and that's the most important thing, working with an actual agent, because the insurance company kind of doesn't matter unless you have an agent that understands it
and how to work it
and how to work it. Yeah. Because when you think about where we store our money, do we go through the same rigmarole trying to figure out the perfect bank to use?
Yeah, not necessarily.
Not necessarily.
So what I would say for you all, if this is something that you're thinking that you want to do, then definitely click on the link in our video description, and we would love to serve you so that you can shift the storage facility for yourself and create better options for your family so that you can start earning uninterrupted compound interest.
Yeah, and at the very minimum, just click on the video and watch our video to understand a little more about the process and how it works.
Click on the link to watch our masterclass, because we have a whole hour video where we talk about how this whole infinite banking process works so that you can really understand the nitty-gritty details and how you can make this work for your family.
Yeah.
Now, going back to the book, again, Becoming Your Own Banker, this is something that we absolutely recommend that you read if you are interested in this concept, because this is basically like, I call it our holy grail when it comes to finances, because we just reread constantly. We're always getting new tips and ideas and thoughts from this book, because for us, we use it as a workbook. So I just want to read this one more time to make sure that we bring it all back home, right? So the very first principle that must be understood is that you finance everything you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. Now, in this video today, what we're trying to teach you to do is that you can have your cake and you can eat it too. Ooh, that rhymed. I'm on fire. So going back to the whole life insurance policy, if we just change storage facilities, we are able to earn interest and we're able to pay interest. When we pay interest, we are going to utilize this life insurance policy basically like our own credit card, our own line of credit. And I'm just using that for simplification so that you all understand how this whole thing works. And we're going to pay interest to ourselves for using the money because we would have had to finance the funds anyway. And I feel like once you understand this first principle that Nelson talks about, the process really cements itself, because so many times people are like, oh, I'll just pay cash for this and it's fine. But remember, if you pay cash, you're losing your purchasing power. You're not keeping up with inflation, and then you're putting yourself even further behind because you're no longer earning money on that money that is now spent and gone.
Right. But the thing is, cash is still king.
Yes.
Cash is still king. But when you spend it, you lose it. You lose that power that you had. So what we're recommending that we do with inside of our policy, the only way we can get a loan is if we actually have the available cash. So we're leveraging the cash. Cash should be leveraged, because even when you think about you getting a new home and getting a loan, well, you have to show that you have money in your bank account in order for you to get that loan.
Absolutely.
So you're leveraging your cash in that situation. Leveraging cash for a home isn't the only way or only position that you can be in where you can just leverage your cash to get a good deal. You can do that with anything. For us, we leverage our cash with getting a discount on our rent. We said that we can pay our rent up for the year. How much of a discount you can give us? They gave us 2.5 months off, 2.5 months free. That's how we leverage cash to get something that we want. This really works in other countries. It really works in other countries.
Yeah, but the other thing to note, when we're talking about cash is king in the sense of we're using OPM, we're using other people's money, which is the insurance company's money. We're using our money, right, or our cash as leverage.
It's flash money, leverage.
To get a loan from the insurance company so we can use their money. And now we're still holding on to cash. So all we're doing is spending their cash and allowing ours to continue to earn that uninterrupted interest. So that's why year after year after year, we're able to borrow more and more money because our money is not being touched.
Right. And it's the same exact formula that the banks use. Again, we're just changing the storage facility, which is key.
So again, we're just making sure that you understand with this whole process, when we're talking about cash, we're not saying not to use cash. We're saying to use someone else's. Always use someone else's money before you use your own, because we don't want to lose the purchasing power.
Right. As soon as we use our money, then our money's gone.
Yeah. So let's rinse and repeat, figure out a different opportunity, a different solution that we can do, and utilize an insurance policy to make this happen. So that's why we say with the title of this video, maybe there's a better option, and there is. And sometimes we just don't know that there's other options and other opportunities out there. That's why it's so important that you read and you study and you continue to close the knowledge gap as far as your money or your health or whatever it is that you're trying to learn more about, because you just don't know what's out there until you start reading books and immersing yourselves around different individuals who are doing creative things with their money.
And actually start embracing the journey, because you don't learn how to ride a bike until you get on it. And once you get on that bike, you start figuring out other things that you can do. Same thing with swimming. You don't learn how to swim until you get in the pool. And once you get in the pool, you realize there's other things or other abilities that you have. That's the same thing with life. You don't understand, there's no blueprint for life. There's no book you can read for life. You just have to get out there and start doing it. Then you realize there's other things that you can do. Now, when it comes to using whole life insurance, we refer to the term as infinite banking, because that's what the concept was introduced to us is called. But when you get into more money, or you add more zeros at the end, you start to call it something different. So the point that I'm trying to make is, you can read all you want. You can listen to us. You can listen to other people on YouTube. You can work with other agents. You can do whatever you want. But until you start taking action and practicing these tips and tricks and techniques that we're talking about, it doesn't hold a candle to what you'll know once you embrace the journey.
having an open mind, and that comes with mindset, that comes with everything, and which is something that we also teach is, how powerful is your mindset? Because when it comes to introducing concepts such as these, when it comes to introducing how to be more creative with your money, you have to be open, you have to be able to embrace the journey, you have to be able to understand how, this millionaire mindset that you have is going to either affect or effect what you do with your finances, how financial freedom is going to play out for you. We have always been very open with money, and that's why we're always open to receiving different strategies and tips and techniques, and we learn it, and then we figure out, does it make sense for us to incorporate? That's another thing that I would probably share is don't get distracted. That the shiny object syndrome is real, and make sure that you stay on path. If this is something that you feel that resonates with you, then continue watching our videos, check out our masterclass, continue learning about the infinite banking concept, because all we're doing is just a simple little shift that is going to exponentially change what we do with our finances. We're not even talking about investing. All we're doing is talking about rerouting our savings account. And it's just one simple little trick.
Yeah. Now it's simple if you have a savings account. If you have some money, if you already have a habit, if you already have some money to control, because the secret sauce that the banks have is they don't have any capital of their own. They just control ours. So in order for us to control ours, we actually have to have control of it. There's some of us that want to jump in and do things without any money. It doesn't work without having any money to control. So coming into it, you have to have some control or sense
some funding in place.
Some funding in place. That's why we always harp on paying yourself first, making sure that every single time you get paid, you set aside money just for yourself, and what's left over is what you spend, not the other way around.
Yeah. I'm glad that you made that point, because with money, when it comes to flipping money or doing anything with your money, you need to have money in the first place. So infinite banking is definitely something that people need to get into. Again, I don't want to reiterate what you said, but we need to make this point clear. You need to be able to bring some money to the table so that you can start a policy and that you can start cash flowing. And then also the discipline, really more than anything, it's having the discipline of respecting your finances. You should already have that very much worked out prior to getting a policy, because if you don't have the discipline in place to manage your finances, then having a policy probably is going to be difficult for you, because you're not going to be able to continue to pay the premiums year after year.
Right.
So what we'll do really quickly, thank you all for joining us. If you're still with us, and hit the like button. We have a few questions that are in the comment section that we'll answer before we sign off.
Yeah, we'll just spot check a few of them. One of them I said, what do we think about term? Term, whole life, not whole life. Insurance has a variety of different products for different purposes. Term, it doesn't have any cash value, so it doesn't apply for what we're trying to accomplish when it comes to doing infinite banking and leveraging the cash value in order to own our own lifestyle, so to speak. There's no cash value available in term. Not saying that it's a bad product or anything wrong with it. It's just not something that it's not a product that can be used to do infinite banking.
I think it's important that we stress that term insurance, there's nothing wrong with term insurance. I feel like there's always like this rivalry, term versus whole, and which one is good or bad. You have to understand what is your priority. For us, the priority is we want our cash to do something. So we have to go into the whole market. When you buy a term policy, it doesn't do anything but provide death benefit.
For a term.
For a specific period of time. Exactly. So what we have to do is we recognize, do we want to put our money in something here where we don't necessarily have any other perks that we can utilize with this policy, or do we want to have a policy that's multifaceted, I guess, if you will. So again, there's nothing wrong with either one, but you just have to determine what is it that you're trying to do with your money.
Right. And for us, I'm 35 years old. I'll be 36 this year. And I'm betting with the insurance company. That's why they give me such a good rating, because they feel like, based on their actuarial tables, that I will live to be an old man, because I'm healthy. I don't smoke, none of that stuff. When it comes to term, we're betting against the insurance company, because what we're saying is that we're going to die before the term's up. We're betting against the insurance company and all their actuarial tables and engineers and stuff that they have, that we're going to pass before the term's up. And the thing is, there's a high probability that you will outlive your term policy. Because the banks do their due diligence, not the banks, the insurance companies do their due diligence. They understand your family history. They do a blood sample. So based on some unforeseen thing happening to you, you're going to survive. That's why only 4% of people actually cash out on the death benefit of a term policy.
Yeah, and you make a good point, which I don't know if many people understand. Term insurance is for a specific period of time. Whole life insurance is for your whole life. It goes out 100 years. So for us, instead of having a term policy where we have to keep renewing and renewing and renewing.
And then it becomes more expensive because when it's up, we're older.
So, right perspective. Darius just said he's 35. He buys a term policy for 10 years. 10 years, he's 45. Now he's older. It's more expensive for him to insure. And then he has to keep renewing every 10, 20 years, whatever the term is. And again, remember, throughout those 10 years, those 20 years, whatever the term is, you haven't done anything with the policy. It's just on a shelf and it's just waiting for you to expire. Whereas we want to have a product that we can build with throughout our whole life and we can do something with so that it allow us to really change the trajectory of our finances.
Right. And as we're on the topic of age, I see a couple comments in the chat about age. What if I'm 50 years old? What if I'm older? What if I'm late to the party? The fact of the matter is that in the product in which we use whole life insurance is based on your age, is based on your health, and whether or not you smoke or have any pre-existing conditions that would make you a risk to pass early. So with that, it's going to affect the death benefit in which you can qualify for. The cash value, on the other hand, the cash value will be the same. So the cash value for me at 35 will be the same cash value for someone who is 55. The difference will be the death benefit, because that's what the insurance company is. That's what the insurance company is in business to insure your death.
Yes. Yeah.
We're just using it for a different purpose.
Exactly. And going back, I see another comment about insurance companies. So for us, it's not that we're not trying to answer the question, guys, that as long as you work with a mutual life insurance company that is dividend paying, you will be okay. The thing that we keep stressing is that you need to work with an agent who, one, understands how to create this product, because there's a lot of agents out there that say that they do, but don't necessarily know the ins and outs of it. So that's why we're saying partner with an agent who understands how to make this work, because at the end of the day, all the insurance companies are very, very, very comparable. So the game changer that's going to be for you is working with an agent who understands how to design a policy such as this and who can actually coach you through the process, how to get a loan, how to make sure that you're making money, how to make sure you're capitalizing, how to keep the money going. Because if you just buy a policy with the top insurance company and don't do anything with it,
you just have a life insurance policy.
You're not doing infinite banking. You just have a life insurance policy that is now sitting on a shelf, and you might as well have just bought term insurance.
Yep. I also see a question about how much do you start with? Well, how much you start with is based on you. It's based on your comfort level. It's based on the habits that you have of saving money on every time you get paid on a monthly basis. If you are okay with saving money, you need to have that habit before getting into this, because when you talk about permanent life insurance, you're basically going to be paying for a very long time. And there's a variety of different ways you can go about it, but make sure that you have your habits and money situated up front before getting into it, because just having enough money for the first year or 2 years, that's not good enough. You have to understand where the money is going to be coming for a prolonged period of time, because if you don't pay your premiums, and your policy will lapse, and that will basically erase everything that you had going on.
Totally.
So start where you're comfortable with. Make sure you pay yourself first, and then get into a policy once you have that habit created.
Yeah, if you're plus 60 years old, then you definitely have to come to the table with at least $10,000 or more at a minimum, for this to make sense for you, again, because it is going to be more expensive for you to get started. If you already have insurance, then you may entertain insuring your children or maybe your grandchildren. That might be an option for you, but you typically have to have insurance first. That's what the insurance companies kind of like to see, is that the hierarchy is covered. One thing that I wanted to go back and look at is somebody said, what link in our description do you click click on. It's the one that says watch our masterclass. You have to watch our masterclass first to make sure that this is something that you want to commit to prior to getting in contact with anyone on our team.
Yeah. And again, with the insurance companies, it's more important that you find an agent that understands what you want to accomplish, because we have policies with 3 different companies, and they all work the same. Yeah. Because we just wanted to try it out.
We wanted to see how they perform. And that's why we go back to work with a mutual dividend paying life insurance
and they're
company.
all the same premiums.
Yeah, the cash values are very comparable. The dividends are very comparable. The thing that changes is, what are you doing with the cash? There's going to be a lot of people out there that are just going to stress the policy design, and they do nothing about what happens after the policy. That's not what we're talking about. What we're talking about is what is happening outside of this policy.
Yeah, and another.
I was going to say, going back to funding, usually for those of you who are trying to figure out what do I get started with, for us, what we found just through our experience is it really doesn't make sense for you to start a policy with less than $6,000 annual. And that's regardless of your age. But again, remember, if you're 60 plus, then it's going to be more expensive for you. So that these are just suggestions that we say in order for this to make sense, because there's always a cost to everything. You have to remember, at the end of the day, we're still buying a life insurance product. So there is some money that's going to go towards the death benefit, and it's going to cost some money.
Yeah. And which company performed the best? We did, because we used our policies. We used our policy. The interest that you earn inside your policy is pennies compared to how much we're paying in interest on a daily basis for everything that we finance in our life. Pennies.
Yeah. Remember, because when we first started this video, Darius was saying we were paying over 100% in interest. So, the insurance company is going to give us a set rate, but outside of the policy, we're covering all of that. So which company worked better? The Bank of Brit.
Significantly.
We are the ones who are outperforming the policy time and time again. We're just using the policy as a storage facility to earn uninterrupted compound interest. That way, while we're out playing in the garden, we can continue to feed the fruits, water the soil, bring the money back so that we can continue to just recycle the funds over and over again. So don't overcomplicate this, ladies and gentlemen. Just get a whole life insurance policy with an agent that understands the infinite banking concept. Everything else will come after that. How soon can you get a loan once it's set up? 30 days. You have to wait 30 days when that policy is enforced, typically. We get a lot of international questions. I'm in Australia. I'm in the UK. I'm all over the place. Can I do this? We, for right now, do not know how this works beyond the continental United States. So until we find that out, we're going to continue to research and find ideas, because we know that there's so many solutions for our brothers and sisters outside of the United States. We just haven't found it out just yet. So let's see. I have no debt. Fantastic. If you have no debt, you get to skip a step, my friend,
and you start investing.
Put your money in a policy, take the cash and use it to invest. That way your funds, remember, they continue to earn that compounded interest, and then you're earning another rate of return outside of the policy.
Right.
So let's see. I think we're good as far as everything that we've covered. Going back to the point again, remember, I'm just going to read this one more time so that we can sum this up. Page 21 of the Becoming Your Own Banker book by Mr. Nelson Nash. He is the founder of the infinite banking concept, which is a concept that we preach. This is what our YouTube channel is all about: financial freedom and how to do better with your finances. So what he says is the very first principle that must be understood is that you finance everything you buy.
Pause there. So that means there's an opportunity to earn interest on every single thing that you buy. So the amount of interest that you're earning in the insurance company isn't even a conversation once you start using your policy and seeing how much money you're redirecting back to yourself, because that's huge.
It is huge. And then the next point is you either pay interest, or to finish that, you either pay interest to someone else or you give up interest you could have earned otherwise. So right now, today, go look in your finances. Where are you paying interest and where are you giving up interest? And once you find those numbers out, it will be really interesting to see how many people are looking into getting whole life insurance policy so that you can have your cake and eat it too. So just remember, ladies and gentlemen, to check out our next video where we talk about how this whole process this works. And remember to own your own lifestyle.
Or someone else will.
If you have $10,000 in the bank today, we are going to tell you exactly what you need to do to flip that money for your benefit. My name is Carmen.
And I'm Darius. And when we say we're going to tell you exactly what you need to do, we're just going to say what we did with the money when we had $10,000 and how we got started in our business and how we've been able to prosper moving forward.